Morning, folks. Afternoon or evening, wherever you are. You hear me?
Yes, sir. Good morning.
Good. So as I'm looking at you, I'm also looking at the master sheet for the class to see who's not put their company names in. I won't embarrass you by calling on you, but if you haven't put your company name into the sheet, please do so. I mean, if you're still picking, make a choice. In fact, most of you have put your name in, so that's good. No. At some point, I will call on you about your company. So if you just pick a company and just forget all about it, that might be a little embarrassing when I ask you what your company does and you really have no idea. So I would suggest that you kind of, once you pick your company, start moving on the project as well. Okay, so we're at 9:30, so I'm going to, or 12:30, so we're going to get started. Are there any questions before we start? Because we've had a week since our last class. You might not remember where I left you off. But we were still talking about the end game in the business, right? What are we trying to do? We talked about maximizing value, and then we proceeded to shred that objective by talking about all the things that can go wrong, right? Managers can put their interests over stockholders, lenders can get ripped off, companies can lie to markets, markets can be irrational, there are social costs, there are social benefits. And then I presented you with alternatives. I tried to be as open as I could be about those choices. You could take the Japanese and the German system and try to run with it, right? Where instead of stockholders bearing the burden of essentially keeping companies in line, you had managers do it. It's an elitist system. A group of experts decide who should run companies. We talked about what could happen with that. You could end up with managerial corporatism, where the manager's interests get put every single time above everybody else's interests. Or worse still, crony corporatism, where essentially you've got connection between companies and governments and regulations and laws, where companies benefit at the expense of society. I also talked about stakeholder wealth maximization and how cynical I feel about that entire push towards, hey, let's take care of everybody and make them all happy. It's a kumbaya moment, but I don't think it does much more than, we all dance around the campfire and nothing more comes out of it. Now, a couple of you have reached out to me about ESG, and I completely understand that, this is something that people feel passionately about. But no, you can feel passionately about something and end up doing all the, you can do things that you think advance that cause, but end up doing very little for the cause. So with ESG, my point is not that I don't want companies to be good. Don't misunderstand me. It's that the way we're approaching this process, I think, is dysfunctional. We're going to end up with companies that sound good, not do good. And towards the very end of the class, I circled back to markets. And I want to be very clear about what my defense for markets. It's not that markets are efficient. I don't want to go there. Clearly, markets are not. I mean, how do you explain what markets did with GameStop just a couple of weeks ago? It's not that markets don't mistakes. They make some horrific mistakes. My biggest defense for markets is markets have no ego. When you make a mistake, what's the biggest block in dealing with that mistake? Admitting you made a mistake, right? If you don't admit you make a mistake, how can you actually fix the mistake? It's human nature when you make a mistake to dig and dig deeper. If you have experts make mistakes in whatever dimension of life, you know what they do? They're experts. They've never been wrong in their lives. Remember, these people were at the top of their class all the way through school, all the way through college. Everywhere they've been at the very top. And they're not used to making mistakes. In fact, that's not in their mindset. So when they make mistakes, what do? They dig deeper. I mean, you think about, the Vietnam War, right? I mean, the Vietnam War was conceived by the very best and the brightest. I mean, if you go back and read about the group of people that came together in the mid-60s in the US, these were not dumb people. They were really, really smart people. But once they made the mistake, They couldn't admit it, so what did they do? They dug deeper. You can say that pretty much about any horrific market crisis or any crisis in humanity. Usually, experts get you in there and they dig deeper. Markets have no egos. What I mean by that is when a market sees a mistake, you know what happens? It knocks the price down 90% in minutes. And that is a huge plus in this process. And that's where I'm going to come back to, is I'm going to talk about the fact that every one of the linkages I talked about, where one group overreaches, managers overreach on stockholders, companies rip off lenders, managers lie to financial markets, or companies create social cause, markets have a built-in mechanism for correcting those mistakes if you will let it do it. And we were starting on the managers taking advantage of stockholders, and there the backlash takes a couple of forms. One is stockholders get madder and madder. I called it the critical mass of piss off, where you get pissed off enough that you will do something about it. And activist investors step into the fold. This is the perfect scenario for Carl Icahn. Stockholders are mad at a company's management, activist investors step in. And in extreme scenarios, if you piss off your stockholders enough, you become the target for a hostile acquisition, because an acquirer can come in and say, hey, just sell your shares to me. They don't care about you, and you're ready to do it. Those forces, if you let them work their way through, will create changes. So in the aftermath of big corporate governance scandals, you saw this pushback from activists, and especially about 20 years ago, 25 years ago, you started this pushback. And you know what they accomplished? They managed to make boards a little more responsive. Boards became smaller. That 17-person board that you saw at Disney, you don't see very much anymore. Insiders got pushed out. Even before Sarbanes-Oxley and all the laws, investors pushed insiders on the boards. Directors were increasingly asked to hold shares in the company, to think like shareholders. And if you look at many companies, especially about 25 years ago, you started to see a move away from the CEO picking who sat on the company's board to a nominating committee that, at least in theory, was supposed to be independent of the CEO. Those are all good things, right? So let me take you back to Disney, since we were telling the story of Disney. Remember the 1997 board that I showed you at Disney? And I described it as one of the worst boards ever created. Michael Eisner was an imperial CEO. He'd created a rubber stamp board. Over the next few years, the Disney board started to change. You know why it started to change? Not because the laws did it, but essentially because stockholders started to lose faith in Eisner. To give you a little bit of history, in 1996, Eisner went out and bought what was then a publicly traded company. Capital Cities ABC was a publicly traded company. Disney bought Capital Cities ABC because they wanted to be in the broadcasting business. And Eisner boasted about the fact that he pulled this off single-handed. He talked about meeting Tom Murphy, who was the CEO of Capital Cities ABC, after some kind of conference and talking about doing the acquisition. He said, I did this. And he was very proud about the fact that this was his personal mission. And he told shareholders, trust me, I know what I'm doing. And that acquisition blew up in Disney's face. In fact, between 97 and 2000, Disney's stock price dropped by about 35%. You know how difficult that was to do between 97 and 2000? This was the dot-com boom. Everybody was going up. This was almost like a perverse objective function. I'm going to lower the stock price. And Disney kept doing it year after year. And each year that happened, stockholders got madder and madder. And it showed up at annual meetings. They got up and they voiced how unhappy they were with the management. And it all came to fruition in 2004 when Comcast mounted perhaps the most insulting hostile acquisition bid of all time. And here's what was insulting about it. Usually when you're trying to buy a company, what do? You take the price that it's trading at and offer a premium, right? You know what Comcast did? It took the price Disney was trading at and offered to buy the stock at a discount. I said, why would they do that? Who would? This was me. They had no interest in actually doing the hostile acquisition. They just wanted to send a message to Disney: your stockholders hate you so much, they will actually sell the shares to me at a 15% discount. Of course, the hostile acquisition didn't go through, but the message got delivered. In fact, in 2005, Eisner decided to step down. He claimed it was voluntary, but it was clear he was pushed out. Even that rubber stamp board said, hey, Mike, you've got to go. No, people just don't like you. And he tried to make changes. It wasn't that he wasn't trying. He tried to make the board more responsive. He made it smaller, fewer independent, fewer insiders. He got rid of his personal CEO, at least. That's good news. He tried to make the change, but basically it was too late. He stepped down and he was replaced by what I call the anti-Eisner. You know how when you replace somebody, you often replace them with the exact opposite kind of person? In the case of Disney, he was replaced by a guy called Bob Iger. Remember, I described Eisner as a person whose ego was so big that when he got into a room, it just felt crowded because he was there. Iger was the exact opposite. He was low-key. He came in and he created a board that was smaller, more independent. He talked about watching the company for the shareholders. Clearly, he seemed to be exactly the right replacement for Eisner. And you know what? For the first few years, it worked really well. Disney climbed the ranks. Remember, I talked about corporate governance scores and how they measure how responsive they are. Disney went from being at the very bottom of the list of entertainment companies to the very top. Iger was doing a very different job than Eisner, and he was getting a very good response from shareholders. In fact, in 2011, Iger did something that CEOs don't do. He was still in his 50s, and he said, you know what? A good company needs a succession plan. And to get ready for the next CEO, I am going to step down in 2015 and spend the next few years grooming my successor. This is good, right? A CEO recognizes he's done a good job, is going to step down at the peak of his powers. But here's where the story takes a turn. The board of directors that Iger had picked stepped in and said, hey, Bob, you can't do that. You're too critical to the company. Without you, there is no company. Initially, he said, no, I'm not that important. I'm sure somebody else can run Disney. And they went back and said, no, Bob, you're really, really critical. Without you, the company cannot run. You know, whether you've ever seen the Shakespeare version of Julius Caesar. If you remember in Julius Caesar, he's offered the crown. Remember, Julius Caesar was just a senator, supposedly, who'd stepped down in 2 years. But the Senate comes to Julius Caesar, or some senators come to Julius Caesar, and say, you're too important for Rome. You have to be king. The first time they offer him the crown, he says, no, I'm not that important. Second time, no. And the third time they offered, he said, you know what? You must be right. And he puts a crown on. So in 2011, the board comes back to Iger and starts pushing and said, do you really want to step down? In fact, we'd like you to be chair of the board, because he'd actually stepped down as chair of the board. Remember, that was a bad practice at Eisner. He'd stepped down. And over the next few years, shareholders started to get more restive because it looked like Iger was consolidating. In fact, remember the 2015 year that Iger said he was going to exit? The Disney board got Iger to stay on as CEO. They said, you should stay on. You're much too critical. Big things are happening at Disney. You can't leave now. So in 2015, Iger announces that he's changed his mind. Shades of Julius Caesar. And it created a ripple effect at Disney. And here's what the ripple effect was. There were people below Iger who were waiting their turn because they knew he was leaving in 2015. And when he said he was not going to step down, Thomas Staggs, was considered his heir apparent, said, hey, you know what? I'm not waiting around. And he left. In fact, it emptied out the ranks of people who would have been his natural successors. And then in 2017, Disney goes out and buys Fox. And you remember all the rationales. We want to control Hulu, incredibly stupid reason to buy an entire company. You're buying a pig in a pot just because of some food it's left on the side. But basically, that acquisition basically meant that Iger was now stuck because he made this big acquisition. It was his acquisition. In fact, by the time you got to 2019, people are looking at Disney and says, who's going to replace Bob Iger? There's nobody left. In 2020, as if you've read the news, in February, in a surprise move, Bob Iger did step down and was replaced by Bob Chapek, who was head of Disney theme parks as the new CEO. Nobody saw this coming. In fact, I would love to know what the inside story is. But my point is, when Disney started, so when Iger started as CEO of Disney, he started from the right place, right? He viewed himself as part of a management team. He cared about succession plans. He listened to the board. But the longer he stayed on as CEO, the more imperial he became. When politicians often talk about term limits, they always talk about them. They never vote on them. Maybe we need term limits for CEOs. Because it looks like CEOs start good, but the longer they stay in place, the more power they accumulate. I know this will not be popular among CEO circles, but I think it's something worth thinking about, because when you look at companies, often when you get a new CEO, that CEO is the right person at the right time, but the longer they stay in place, the more things seem to melt down. Now, along the way, of course, you had legislation to make boards more effective, more independent. Sarbanes-Oxley. You know how many pages the Sarbanes-Oxley Act was? More than 1,000 pages. Nothing that Congress does is readable because everything is war and peace. 1,200 pages. And it created a lot of rules for boards. You can't do this, you can't do this. And guess what? It did create one outcome. Boards were, at least on the face of it, more independent, because they removed the obvious conflicts of interest. You can't have your brother-in-law on the board and tell me that board member is going to be independent. So I wonder, is Kimball Musk on Elon Musk's board at Tesla? I would love to know. After all, I don't even know what that board does, so it might explain a lot of things. But you can create independent, ineffective boards. That's basically what Sarbanes-Oxley did. Because ultimately, you can't legislate good corporate governance, just like you can't legislate good democracy, right? Let's say you passed a law that says every voter should be informed. How the heck do you enforce that? You could send out stuff to voters. In California, I get like reams of stuff before. They're like 100 propositions. I get hundreds and hundreds of pages, most of which I don't read. What are you going to have? A quiz in the voting booth? You got to take this quiz before you vote. The reality is you cannot legislate that shareholders should ask the right questions. That requires work on the part of shareholders. And that's why last session I said, we get the corporate governance we deserve. So when we complain about how managers don't listen to us, it's because we don't care as shareholders. You might say, but I'm just one shareholder. But that's what we say as voters too, right? I'm just one voter. What can I do? So when you look at corporate governance, that I think is the stumbling block. Until we're willing to put in the time and the effort as shareholders, we're never going to get the kinds of corporate governance we want at companies. Now, if you ask me, is having better governance going to lead to better performance? Well, there's at least some evidence. I'll be quite honest. I don't want to oversell this, because we know there are some companies that are dictatorships that are run incredibly well. Take Google. Okay? This is not a corporate democracy. Take Facebook, not a corporate democracy. So we do know that there are companies that are dictatorships, with imperial CEOs that are run well. We also know there are companies where there's good corporate governance that do badly. So studies have to look beyond the anecdotal evidence. And there are some studies that look at corporate governance scores and correlate them with performance. And here's what they loosely find. Companies with better corporate governance tend to perform a little better, I don't want to oversell this, than companies with bad corporate governance. But I'll give you my pitch for why governance matters. If you get a chance, go back and look at companies that have been big scandals, whether it's Enron, or you go through the list of big companies that get really big scandals. Here's the one thing they will share in common. Every single company with a big corporate scandal, one sort or the other, if you dig deep, will tend to have an ineffective board. That's the one thing that comes through, because when you get big corporate scandals, it's because CEOs make mistakes and then they dig deeper and deeper. It's like we talked about at the start. When you make a mistake, you tend to dig deeper, and nobody checks the CEO. So shareholders take, when managers take advantage of shareholders, the backlash takes the form of activist investors, hostile acquisitions, and you let the process play through. Change will come. You might have to wait for it, but change will come with or without legislation. Let's take the bond. So any questions on that aspect of corporate governance? So my push is not a hard push, where I'm not going to tell you that if you have good corporate governance, you're going to get high profits and a high stock price. That's not going to happen in many companies. But in the absence of corporate governance, you're exposing yourself to the kinds of catastrophic mistakes that can take the company down. No questions? Let's move to the second link, right? The link between lenders and the company. Remember that lenders lend money to a company, they get ripped off if they're not protected, the Nabisco effect. By itself, the Nabisco effect affected Nabisco bondholders, right? But in the aftermath of the Nabisco fiasco in 1988, here's what you saw happening. Corporate bonds started to come with put clauses. You're saying, what's a put clause? Normally, when you buy a bond, you're stuck with the coupon and the principal for the life of the bond, right? A corporate bond with a put clause allows you to put the bond back to the company and get your face value. And the put clauses would be triggered by something like a leverage buyout. You see how useful this could have been when Nabisco was bought out in that LBO deal? Because the reason you were hurt as a corporate bondholder in Nabisco is you had this bond you negotiated when Nabisco was a nice, safe company. Now they've changed the rules and you're still stuck with the same coupon rate. So you go put the bond back to the company, say, I'd take my $1,000 back. You'd have been protected. Too late to protect the Nabisco bondholders, but the bond market learned from its mistakes and started building it in. You start to see more debt become convertible debt. How does that benefit you? If you get ripped off enough by the equity investors, which is what happened in Nabisco, you become one of them. So who are you going to rip off now? So you started to see bonds build in protections, covenants against the kinds of things they saw in Nabisco. In fact, you had notes called rating sensitive notes that Merrill Lynch created, where your coupon rate would adjust to whatever your rating was as a company. So remember, Nabisco went from AA to BB. If you're AA, your rate will be 4%, but if you're BB, the rate jumps to 7%. You're compensated for taking the risk. So bond markets learn, they build it into bonds if you let that process go through. You say, what about markets? What if companies lied to markets? If you lie to markets, does the truth eventually come out? The truth always comes out. There's not a question of whether, it's a question of when. And when it does come out that you've been lying about your revenues or your CAPEX or your profitability, the day the news comes out, what happens to your stock price? You've seen this play out in news stories. When it happens, your stock price collapses, right? That's your first layer damage. You're saying, isn't that enough? There's even worse damage, because not only does your stock price drops, it stays low because nobody trusts you anymore. Remember in the financial balance sheet, we talked about growth assets and assets in place. Growth assets is what I expect you to make in the future. What's the value of growth assets rest on? It rests on me trusting you on delivering that growth. So if you go out and you lied to me about something small in the past, why would I trust you about what you tell me about growth in the future? I've never understood why. I'm not going to condone lying by any firm, but if you're a mature firm and you're lying, you're playing a game. You're going to get caught, but you're playing a game. But if you're a young growth firm and you're lying about earnings last year, what the heck are you thinking? 90% of your value comes from future growth. And to get 2 cents more in earnings per share, you're going to fudge the numbers? What have you gained? So when you lie to markets, not only does your stock price go down, it becomes very difficult to dig yourself out of that hole because everything you say from that point on, nobody believes you. Which leaves me with the final issue, which is in the absence of ESG, how do we make companies behave better? Well, when companies behave badly, and they do so obviously, there's a backlash, right? Initially, there are news stories about you, then you get viewed as a bad company. And once you get viewed as a bad company, God help you, because you can be targeted and nobody comes to your defense. I remember well before ESG, tobacco companies got labeled as bad companies for obvious reasons, which is, hey, your product creates cancer and you are hiding the fact. And there was this famous tobacco CEOs coming in front of Congress. If you go on Google, you could probably find the videos where they claimed that they weren't quite aware. It's just a horrifically bad public relations fiasco. So tobacco companies got targeted as bad companies, probably in the late 80s. Did it affect them? Absolutely. You had states pass laws specifically directed at tobacco companies. And nobody came to their defense because they say you deserve to be targeted. Their stock prices reflected, they got sued, and they essentially paid the price financially. Let me ask you, and this is a thought experiment. ESG claims that one of its big successes has been in fossil fuels, right? It's a thought experiment. Let's assume ESG had never shown up. What do you think would have happened to oil stocks for the last 10 years? I think that public opinion based on climate change or whatever you're reading started to turn about 20 years ago. It took a while to build up. That fossil fuel companies would have suffered over the last decade with or without ESG. I can't prove it, obviously. My point is, if you're a bad company and people view you as a bad company, it becomes very difficult for you to operate. Remember, your objective is to maximize value. You've now ruined that basis. You guys remember Valiant? Valiant was a Canadian pharmaceutical company. It was a company where Bill Ackman was one of the lead investors. As a Canadian pharmaceutical company that from a market cap term went from this tiny Canadian company about 12 years ago to by 2016-17 being one of the largest pharmaceutical companies in the world in terms of market cap. It was every value investor's dream company. There were some value investing funds that had 30% of their money invested in value. And I'll describe their business model to you. And you tell me how you would present this model to the rest of the world. Here's what Valiant would do. It didn't have a great R&D department. It didn't create particularly new drugs, but it looked for drugs that had already been okay 10, 12 years ago, that had 7 or 8 years left in their patent protection, that people really needed, that Valiant felt that the drug was underpriced. I will leave you to think about what does that even mean. So you have, I don't know, a very severe case of asthma, there's this drug, and these drugs were not drugs for large portion of the population, they were treating small, so maybe 3 million people have this disease, they absolutely need this drug. And right now you're paying $30 a month. Valiant said, you know what, these people could possibly pay $300 a month. This company is not taking full advantage of its pricing power. We're going to buy this drug from the company and we're going to reprice it. And they also invested in in pharmacies, online pharmacy companies, to make the push that this could then become the drug that would get prescribed, and then people would pay $300. And it succeeded in terms of delivering value for a while. Until news stories started to pop up, and this was just a question of time. As they got bigger, their impact got larger as well. More people were complaining about the fact that this inhaler they were taking that cost $1 was now costing 10. And at some point in time, Valiant made that jump between being a company that's got this interesting business model to a company that was viewed as crossing the line. So then congressmen, senators started talking about how Valiant had to be stopped. And the process kind of unfolded. Valiant imploded because those stories came to the top, and now they were under scrutiny, and people found all kinds of things they were doing that were at the margin, perhaps legal, but not quite ethical. The company's market cap melted down by 90%. That was the first level damage. You know what the second level damage was? They started losing employees. Nobody wanted to work in their R&D department. Would you want to be a scientist working in the Valiant R&D? No, so ultimately, you know what they had to do? They had to change their name. Does anybody know what Valiant's current name is as a corporation? They actually named it after one of their divisions, actually a very well-known division, Bausch and Lomb. That was one of their divisions. They decided to rename themselves because they realized they could not survive as a company because of the damage they'd done to their name. If you want companies to be socially responsible, you have to make it in their financial best interest to be socially responsible. Otherwise, it's going to be all talk. In the case of Valiant, you saw that play out. So let's review where we are. Let's take each of the links and talk about the backlash. Managers take advantage of stockholders. Well, you get activist investors, you get hostile acquisitions. Lenders get ripped off, you have new kinds of bonds, you get protections in debt. You lied to markets, your stock price drops and it stays down, you've lost all credibility. And you're viewed as a social outlaw, you get punished in multiple dimensions, right? Endowment funds can't own your shares. Customers stop buying your product. Employees don't come to work for you. That's the market mechanism. And I know you're trusting the market to deliver on it, but I call this constrained corporatism. And in my view, this is the world we live in. We don't live in the robber baron corporatism of the 1800s. We live in this world. So when people say, when you maximize shareholder wealth, aren't you doing all of this stuff? You have to recognize that this process comes with constraints. That any reasonable company, when it thinks about increasing stock prices, has to factor in these constraints because they can become real costs if you don't factor them in. Are the constraints tight enough? That we can debate. Maybe there are ways we can tighten these constraints. Maybe we can improve employee bargaining power if we feel that employees are being treated in an unconstrained manner. If you as a society believe that there are constraints we need, that's the point. That's the reason we have laws. So here's what I'd like you to tell me, and you don't have to tell me, you just have to think for yourself, because in a sense, I want you to get this nailed down before we delve into the meat and potatoes corporate finance. You're now running a publicly traded company. And I say, what's your end game? What's your objective? And I've given you lots of choices. You can maximize stock prices, which is a market number. You can say, I don't trust markets. I'm going to go out and maximize stockholder wealth, which is based on cash flows and fundamentals. You can maximize stockholder wealth with good with constraints on how much cost you can create for society. Maybe you think that stockholder wealth is not the objective. Maybe you should maximize the value of the entire business because lenders can't protect themselves. Maybe you still believe that stakeholder wealth is a good end game. You can find a way to do it. Or maybe you want to go with one of those intermediate objectives, maximize revenue growth, maximize. This is not a side story. This is going to drive every single decision you make as a company. This might be the most critical decision you make as a company, is deciding what the end game is. So make a choice, because I've given you what my choice is with my rationale. I'm going to focus on maximizing stock prices with the caveat, which is the caveat is when stock prices deviate from stockholder wealth, I'm going to focus on maximizing stockholder wealth with the faith that prices will eventually catch up. Could I be wrong? Of course. But I'm going to argue that any objective you pick is going to come with flaws. The question you're asking is, which of these is the least flawed objective? So if I were to summarize your choices, if you're a publicly traded company in reasonably efficient markets, and you can use, define your own measure of how much reasonably means, you can get away with maximizing stock prices because markets make mistakes, but they catch up with you. If you're a publicly traded company in a market where there is no efficiency, you're a Polish company and your stock is traded in the Polish market, not the most liquid market in the world, you might say, look, I'm going to maximize stockholder wealth and hope and pray that the market catches up with me. If you're in a market where not only is the market inefficient, but lenders are not protected, then I want to take away the temptation you have to rip off your bankers and your lenders and say, look, maximize the value of the business and take care of your lenders because you need them for the future. And if you're a private firm, remember, you don't have a market price to focus on. You have to maximize the value of your stake, which is the ownership stake, or the value of the business, depending on how you approach decision making. But there's no alternative where you can say, I'll come back to this later. That's not a choice. You're a manager. This is something you got to pick up front because everything you do as a company will be driven by that choice. So I'm going to put the objective function to rest here because we've talked almost 4 sessions on it. I think we've kind of exhausted everything that can be said. This is now more a question of, hey, given what you feel about markets, about managers, about experts, and I can't impose my thoughts on you. You have to decide what the right objective is, and that's going to drive all of your decision making. Hillary?
Yeah, you mentioned that based on how efficient the market is, there might be different mediums of constraint for a firm. How can you tell, or how do you differentiate how efficient a market is?
Well, I think this is where this what you believe about markets come in. I believe that markets make mistakes. I believe that markets correct their mistakes and that price eventually catches up to value. So if you ask me to run a business, I'm going to focus on what I think will increase value. If that is taking projects that increase cash flows in the future, I'm going to go out and take it. The market might go down initially, and you're going to come back to it, but the price went down. And I'm going to say, trust me on this one. I think this is the right thing to do. Now, if you as a stockholder don't trust me, you're going to fire me, replace me with another CEO. But I have to do what I believe. I believe that this is the right. But if year after year, I keep telling you, I'm doing this for the value, and the price keeps growing. Now, after about the 7th or 8th day, you're going to come back to me and say, you know what? You keep telling me just wait. I waited 8 years. Maybe what's wrong here is not what the market is telling me, but what you're telling me. So I think this is kind of a dynamic game where trust is based on my history as a manager, what I've done for you. And if that trust fades, and this is why I keep emphasizing the word trust. You don't want to mess with that trust as a manager. You don't want to kind of do things that undercut that trust. Because if I lose faith in management, I'm going to say, look, you can tell me whatever you want. I'm just going to go with the price because nothing else here seems to make sense. So it's something where, I'll be quite honest, I'm not going to give the same answer for every company. If you ask me, if you were running Apple, what did you focus on? I'd probably focus on the stock price. If I were running a small publicly traded Polish company or a Vinamilk, a Vietnamese milk company, what would I focus on? It would be very different because I'm in a different setting, in a different market, with a different system in terms of constraints. So the answer is going to vary even for the same person across companies. But whatever the companies, you have to make this choice up front because it drives everything you do. So ready? We're going to now talk numbers. I haven't talked about a single number so far. So if you're a liberal arts major, you said, this is corporate finance. I love it. It's like history and strategy. Strategy classes are like, you can bullshit for 26 sessions. The bullshit is done. We're now into the numbers. Don't worry, I'm not going to hit you with ratios, but we're going to talk about hurdle rates, probably for the next 6 or 7 sessions, maybe even more. Let me revisit the first principle that's going to drive it. I said the hurdle rate for an investment should reflect the risk in that investment. Let me pause right there. Higher risk investment should have higher hurdle rates, lower. It makes sense, right? I mean, there's nothing to do with corporate, that's common sense. And should reflect where you get the money to fund that investment. Remember, there are 2 ways you can raise money, debt or equity. So this entire process is going to be to put that into practice. So let's think about what a hurdle rate is. Every investment you take as a business has a threshold, a number you need it to beat for it to be a good investment. No matter what company you are, what business is, small or large. So the threshold you have to ask is it 7%? Is it 9%? Is it 15%? I'll lay out the base principle. To get to that hurdle rate, I'm going to start with what I can make risk-free. In whatever currency you're computing the return, so already currency enters the picture. What can I make risk-free? And on top of that, I'm going to add a risk premium. Why? Because I'm not a risk-neutral person. We're human beings. We're risk-averse. Collectively, at least. There are times where we act in a risk-loving way, but as investors, as companies, risk aversion kicks in. The premium reflects the risk in an investment. It's kind of a general statement, but it leaves you with 2 questions you need to answer to put that statement into practice. First is, we need to define risk. Without a definition of risk, we're kind of flailing around, right? What exactly is risk? You might say, I know that already. I'm going to throw the question out to you in a minute, and you're going to see very quickly how the definition of risk varies so much across people. The second is, once I've measured that risk and said, this is my measure of risk, I have to convert that risk measure into a number. It's not just enough for me to say, hey, if it's a riskier investment, use a higher hurdle rate. What the heck do you do with that? How much higher? 5% higher, 10% higher? I need to measure risk and convert it into this risk premium. You ready? I'm going to throw the question. I'm going to pick on somebody. So John Hopkins, you're on the stage here. If I ask you, what is risk? What is your working definition of risk? What is risk?
I'd say the possibility of something going bad for you. And how have you
Very
defined
good.
that?
That's actually a lot of people, when you think about risk, we think about the possibility of negative consequences, right? Nobody ever complains about upside risk. Because anybody come to you and say, oh my God, the stock was so risky, it went up 80%. So already you can see risk is defined by most of us as a bad outcome. Dan, Martin, would you agree with that definition of risk? That it's a possibility of bad outcomes?
I guess it's a mix of danger and reward, right?
You're reading the next slide to me back, right?
Yeah.
But I'll tell you what the problem with John, the reason that I'm a little wary with going down that path is risk is a bad thing. It's a possibility of bad outcomes. What should we do? We should not expose ourselves to it. And if you're a company and you refuse to expose yourself to risk, you know where you're going to end up? As a money market fund. So I'm going to give you my favorite definition of risk. And it's several thousand years old. It's the Chinese symbol for crisis or big risk. I have to tell you up front, I know no Chinese. This could be a gigantic hoax pulled on me. For all I know, this could be something obscene. So I'll protect myself by saying, I've been told that this is the Chinese symbol for crisis. And the Chinese symbol for crisis is a combination of 2 symbols, danger and opportunity. Risk is danger plus opportunity. It's a perfect way to think about risk. You know why? Because it pairs them. It says, if you want one, you got to live with the other. And who amongst us doesn't want opportunity? We all want to make 70% returns, right? You know what this definition reminds you? If you want 70% returns, be willing to live with a lot of danger. Oh, you don't like danger? Don't ask for 70% returns. Think of how many investment calamities would be avoided if we remembered this linkage, danger plus opportunity. I'm in Southern California, I'm in San Diego County, but if I drive about 40 miles north, I'll be in Orange County. Anybody in this class from Orange County? I won't pick on you for being from Orange County. Great part of the country to be in. Sun always shines. There are no orange groves left. But Disneyland is there and the Angels play there. I don't know whether it's a good or bad thing. But about 30 years ago, Orange County was caught up in a financial scandal. That time, still one of the wealthiest counties in the country, its pension, its employee pension fund lost 30% of its value. You know why? Because the treasurer of the county decided to take 1/3 of the money in the pension fund and bet on German interest rates. I'm not making stuff up, bet on the direction of German interest rates. So the treasurer, obviously this is a huge scandal, it's on 60 Minutes. And the treasurer of the county is being interviewed by Mike Wallace. I don't know whether any of you have seen Mike Wallace, but he's a great interviewer. And the treasurer of the county is a guy called Bob Citron. I think everybody in Southern California invents a name. There's no way that the treasurer of Orange County's name is Bob Citron. This is like, Wolf Blitzer. You really think Wolf Blitzer's name is really Wolf Blitzer? If it is, it's an incredible coincidence that he's reporting on defense and wars and his name is Wolf Blitzer. But to get back to the 60 Minutes episode, it's Bob Citron being interviewed by Mike Wallace. So Bob Citron asked Mike Wallace asked Bob Citron, Mr. Citron, you're the treasurer of a county, this is the county pension plan. Why would you speculate on German interest rates with 1/3 of the money in the fund? And Charlie Clough says, and Bob Citron says, because Charlie Clough told me that I could make 15% with no risk. Now your first reaction is, who's Charlie Clough and why is he telling you these things, right? Charlie Clough worked at Merrill Lynch and he was a market strategist. And I don't know Charlie Clough, but I do know market strategists. Have you ever heard a market strategist talk? These guys are the slipperiest people on the face of the earth. They're incapable of making a direct statement. You come out of after listening to them for an hour, you say, what did he say again? I think he said the market would go up. No, I think he said the market would go down. I think he said it would be flat. They're covered no matter what happens. There's no way Charlie Clough is telling anybody you can make 15% with no risk. Let's get back to the interview though. Here's what Citron says afterwards. He says, and I'm not a finance person. What's his job again? He's the treasurer of a county, which I thought was a finance job, but it turns out to be a political job. And he said, I didn't know any better. Let me ask you a question. If I came to you and said, you can make 15% with no risk, Shruti, would you believe me? I mean, right now, let's suppose I found this great investment. I'm a hedge fund manager. I used to work for Steve Cohen. I have all these neat tricks. I can make 15% with no risk.
No, I wouldn't believe you.
Yeah. In fact, if you believe me, you probably also think that Rolex you bought on Canal Street for $45 is really a Rolex. Trust me, if you paid $45 for a Rolex, it's not a Rolex. Look at the spelling. It says ROLECKS. But sometimes things slip through. You pay $45 for a Rolex, it's not a Rolex. If you're making an expected return of 15%, there is always risk. Whether you choose to see it or not is your choice, but don't tell me you have to be a finance. This is why when you get these scandals and investors get caught up in it, part of you feels sympathy, right? You read that article yesterday about, it was a New York Times article, about this guy, he lives in Maryland, I think. He invested in GameStop. He borrowed $20,000 to put his money in GameStop. He ended up losing 80%. Part of you says, I feel sorry for you. But the other part says, look, when you're greedy and you put that greed first, everything, there's no way you're telling me that you thought you were going to make this investment. He said, I thought the stock was going to $1,000. I said, okay, you know what? We all think things, but at the same time, when you think those things, you have to also think about the risk involved. We're not bungee jumpers in corporate finance. We don't take risk for the sake of taking risk. So when you're a company, here's the question you're asking: how much danger am I exposing myself to with this investment? Then you're asking a follow-up question, which is, how much opportunity do I need to compensate me for taking that, for being exposed to that danger? That's what every risk and return model in finance is about, is measuring the danger in an investment and asking, how much opportunity do I need to cover that risk? So let me lay out what I would like a good risk and return model to do. Think of this as the utopian world again. In the utopian world, a good risk and return model would start with a measure of risk that works across all assets. You know what I mean by all assets? It'll be a risk measure that I can use with stocks, with bonds, with real estate, pretty much everything, because as an investor, I've got to pick between them. Second, a good risk and return model will tell me what kinds of risk I will get rewarded for and what kinds of risks I will not get rewarded for, so I can walk with open eyes. Third, a good risk and return model should come up with a measure of risk that's self-standing. You know what I mean by self-standing? If I tell you the risk in this company is X, you should be able to look at that number and say, that's a high number, or that's a low number. I shouldn't have to offer you 20 other companies for you to make comparisons. Fourth, I should be able to take that risk measure and convert it into a percentage return and say, given this risk measure, this is what you need to make on this investment. That's four. And the fifth condition is actually the condition that's going to stymie me. A good risk and return model should work. You know what I mean by that? Is once you come up with the risk measure and told me this is the return you need to make, when I look across companies, a good risk and return model should actually work across companies. The companies that score high on that measure should earn high returns, and low on that measure should earn low returns, at least over very long time periods. So that's what a good risk and return model would do, right? So I'm going to take you back to the early 1960s, when finance was being born as a discipline. And the very first big risk and return model we offered the world was called the capital asset pricing model, the CAPM. I know you've all gone through the statistical derivations, the economic, hopefully in foundations, you did the little, the standard deviation. I'm not going to go there. I'm going to intuitively take you through the pathway that leads you to the end game in the capital asset pricing model. Let's summarize what the capital asset pricing model does. In terms of and so I'm going to set it up against a good risk and return model and see whether it delivers. First, it defines risk as variance of actual returns around an expected return. I'll give you examples of what that means, but it already is giving you a very specific measure of risk, right? It says it's variance of returns, actual returns around an expected return. Second, it says only risk you cannot diversify away will get rewarded. Why? Because marginal investors pricing the stock will tend to be able to get rid of the rest of the risk by averaging out of their portfolio. Third, it takes that non-diversifiable risk and measures it with a beta. So Jeremy Moskowitz, when I tell you the beta for a stock is 1.25, what have I already told you about the stock? Above average, average, or below average risk? Beta is 1.25.
Below average risk.
Jeremy, do you agree?
Above average risk.
Above average risk, you got it. And what made it above average? What's the average beta across all stocks?
1.
Fine. Beta is self-standing. So when I give you the beta, I don't need to give you the rest of the world. Whereas if I told you the standard deviation of the stock is 37%, you're sitting there scratching your head and said, is that high? Is that low? Is that average? Who knows? This is going well, right? You got it. And if I give you the beta, you could be able to give me an expected return. By doing what? Taking the risk-free rate plus beta times whatever risk premium is you demand for an average risk stock. 4 of the 5 conditions have been met. On the 5th one, I'm going to give you a very mild argument for the CAP. What is a good risk and return? It has to work, right? I'll give you my best pitch for the CAPM. It works at least as well as the next best model. Damning with faint praise, but that's about all I can push on it. It's not a great model. It's not even a very good model. It might even be a bad model, but it's at least as good as the next best model. Now I'll offer you alternatives, but let's take you through the CAPM so you can see how this will play out, and then we'll look at alternatives. So what is the first step? We defined risk as variance. And we said an investment where there's a higher variance of actual returns or unexpected return is riskier than one where there's less variance. I'm going to give you 4 investments to kind of illustrate the kind of range of risk you can get. Let's assume you have a 1-year time horizon and you buy a 1-year T-bill. And let's, for purposes of completeness, assume there's no default risk in the US Treasury. You ready? You got a 1-year time horizon, you buy a 1-year T-bill. You know what the rate on a 1-year T-bill is right now? It's about 0.05%. You think that's terrible? It is what it is, so 0.05%. A year from now, I come and knock on your door. Remember, it was a 1-year T-bill, it had a 1-year time horizon, 365 days later, I come and knock on your door and say, what did you make on the T-bill? What's your answer going to be? The T-bill expires, there's no default risk, you'd have made exactly 0.05%. It is an investment where your actual return is always equal to your expected return. That is a riskless investment. So let's keep a time horizon at 1 year and give you a 10-year T-bond. You go out and you buy a 10-year T-bond today. The rate right now is about 1.1%, the coupon rate. A year from now, I come and knock on you and say, what did you make as a return on that T-bond? Daniel Almeida, what's the return on my T-bond going to be a year from now? What portion of my return is guaranteed? The coupon is going to get paid. You're going to get paid the 1.1%, right? What portion is out of your control? Michael Brescher, what could happen to the bond a year from now that could affect your return?
The rates can change.
Rates can change. Let's say rates go up. What will happen to the price of the bond?
Then my price will go down.
So your return next year is going to be, the coupon is fixed, but the price change is out of your control, which means your actual return on a 10-year T-bond with a 1-year time horizon could be very different from what you thought it was going to be. You see where I'm going already? A 10-year bond is not risk-free if you have a 1-year time horizon. Let's assume you go to a 10-year corporate bond. An AT&T 10-year corporate bond. In addition to the rates changing, what else could affect your bond price? AT&T could get riskier or safer over the next year. Its rating could change. You have an additional, so a 10-year corporate bond is riskier than a 10-year T-bond, which is riskier than a 1-year T-bill with a 1-year time horizon. You want to complete the picture? Let's say you really want to buy GameStop. You missed your chance at buying at 20. It's now trading at 49. You say, this is it, I'm going to get in. You do it expecting Ryan Cohen, the Chewy.com CEO, to turn things around, and you expect to make a 15% return. You're not being greedy. You're saying, look, and I've done my research. I think I can make a 15% return. You go out and buy GameStop at $49. A year from now, I come and knock on your door. Here's the one thing I can guarantee you. Your return will not be exactly equal to 15%. If you're lucky, what could the return be? It could be 300%, right? It could be one of those great up moves. Or if you're not, the return could be minus 60%. Or even a minus 100% if the short sellers have their way. You see where I'm going? GameStop is riskier than a 10-year corporate bond. In fact, GameStop is riskier than Coca-Cola. Coca-Cola is riskier than a 10-year corporate bond. If you define risk as what will the actual returns look like relative to expected returns. In every one of these cases, though, where's the risk? It's all in the future. What will happen next year? You see, that's obvious. Why are you making such a big deal? If I ask you how risky is GameStop, after a finance class, what are you trying to do? I sent you that Bloomberg link. You go to Bloomberg, you look up the standard deviation GameStop, and you give me that number, or a beta for GameStop. And if you think about where those numbers come from, they come from looking at the past. It's one of the great disconnects in finance, is all our data is in the past, but all our fears are in the future. We have to somehow bridge that because there is no risk in the past. You know why? Because it's already happened. Risk is always in the future. We'll come back and talk about what to do about it, but it's one of the givens when you think about risk in investing. So if you define risk as variance, and you want to measure that variance, you have no choice but to go backwards because there are no future prices, there are only past prices. So if you ask me how risky is Disney, I could go give you the returns, and this was in 2013, looking at stock prices every month and converting them into returns. And you know how you convert stock price into returns? You take the change in the price from month to month, just like you would any other investment. But what else do you have to factor in if it's a stock? What else could create a shift in your returns? I'll give you a clue. For many US companies, every 3 months, you might get this that could affect your return. Ashwin Balaji, what is the other component when you invest in a stock? Your price change, and what's the other component?
Your standard deviation.
I'm sorry, what?
Standard deviation.
I can't even hear you. David Godless, what's the other component of my returns if I buy stock?
Dividends.
Dividends, right? Which might be every 3 months. You don't get it every day, but yeah, there's certain, which means if you're holding the stock in the month or the period where the dividend gets paid, it's going to add to your return. So for 5 years, I collected the prices, but I also collected the dividends in which month they came in, and I computed the return. So this isn't rocket science. You have access to Yahoo Finance. You can download the price and the dividends, and you can compute the returns. Now take a look at that graph. What do you learn from that graph? Not much. It moves around a lot. It's a stock. And if I put in another stock, let's say I put in Tesla on top of this, Tesla stock will be even more volatile than Disney stock because it's a younger company, more stuff going on. But this is the first stop, is stopping and saying, variance is my measure of risk. But before we leave the step, let's kind of stress test it. Are we okay with that? Is this reasonable? Is variance a good measure of risk? To test this, I'm going to actually offer you a choice. You ready? Every one of you, I come up to you and say, look, I have 2 investments. They have the same expected return and the same standard deviation. So in the capital asset pricing world, you should be indifferent between the 2, right? Same expected return, same standard deviation. But then I throw in a little glitch. I say, you know what? Investment A offers a very, very tiny probability that you could quadruple your money. It's already built into the expected return and the standard deviation, but there's a really small chance you could quadruple your money. Whereas investment B, your best possible outcome is you could make 60%. Every return, same expected return, standard deviation, but one investment offers this tiny chance of quadrupling your money. The other offers the best. Could that? So I'm going to ask for for you to think about the answer, and then I'll open it up for this. Now, how many of you would be indifferent between the 2? Would anybody in this class be still indifferent between the 2 investments? Kushal, you said you'd be indifferent.
Yeah, if you say the return's built into the return, the risk is built into the 15 and 25%.
So you're saying the possibility that you could quadruple your money is not even an issue because it's already built into the expected return. Mara, would you agree with that?
Initially I didn't, but that is a good point. And now I'm starting to think that that is the case.
Remember, so Shruti, you're shaking your head. Would you pick one over the other?
Yeah, I mean, I might not be correct, but I would pick A over B.
Because and you know why there can't be a correct answer? What does this come from? It comes from what you get utility from. If you think there's a very, very tiny chance you could quadruple your money, but think of how happy you feel when that happens. It's like hitting it's a reason. If you think about, I don't know whether any of you buy, the New York lottery, but what's your expected return when you invest in the lottery, if you can call it that? In fact, it's very open. They take, I think, 30% of the proceeds out of it. So basically, your expected return is minus 30%, right? So why do we buy lottery tickets? Partly because, people get desperate, but partly because that payoff of 300 million, think of how big some of these lottery winnings become, right? 300 million. It's tiny, it's infinitesimally small, But that huge payoff is something as human beings we value. Not all of us value it. Kushal says he doesn't care about it, and that's perfectly okay. In the CAPM world, everybody's like Kushal or Mara. And that's an assumption. If people value big potential payoffs, they will pay more for investment A than B, even though it has the same expected return and standard deviation, because of the possibility of that large payoff. You know how this would play out in the real world, right? If I give you a stock like Tesla versus another stock which has exactly the same expected return and standard deviation, you might pick Tesla and pay a higher price for it, because there is this chance that if things hit on all cylinders, you could quadruple your money. At the risk of throwing in a kind of a buzzword, it's called preference for skewness. Basically, that upside outcome is called skewness. We as investors like that possibility of a very big positive payoff, even if the chances are small. And we'll pay a higher price, and evidence seems to suggest that this plays out in practice. Let me go back to the example now. Take out this big positive payoff. What if I told you that there's a chance that at least on A, that you could lose 100% of your money. And on B, the worst case scenario for you is that you can lose only 50%. So what have I done? I've made investment B's distribution tighter. In fact, in statistical terms, your tails on your distribution are kind of constrained on B. They're much more expanded on A. Could that affect your decision? Absolutely. We're human beings. What we prefer will vary across people. Some people want that big payoff. Other people are risk averse. They think of worst case outcomes and they will not invest in a stock if it can drop more than 30%. They're not being irrational. How can we call that irrational if that's what's in your preferences? But in the CAPM, we're assuming away those assumptions. And at each stage, that's what I'm going to do. I'm going to point out the CAPM assumption and say, you know what, it might not hold in the real world, which can then explain why it might not perform as well as you expected. But that's the first stop. Risk is measured with variance. Let's go to the second stop. Not all variance is created equal. When you invest in a stock, you're exposed to all kinds of risk. Let's take Disney. And I'll go through some of the risks I'm exposed to. And as I go through these different risks, think about what sets them apart. I don't know when the next big Avengers movie is coming out. Yeah. But let's say it's a $250 million new movie. It's going to come out in 9 months. Now, Avengers movies have always been hits, but there's no guarantee that they'll continue to be hits. Let's suppose during this COVID crisis, one of the huge shifts that happened is people actually like DC movies more than Avengers. Fat chance of that happening, but let's assume that happens. There's a possibility that when the Avengers movie comes out, that we won't want to see it. So is there risk to Disney from a big budget movie? Absolutely. And if that movie crashes and burns, you know who's affected? Disney is affected. The economy doesn't come down because you didn't go into an Avengers movie. The rest of the business is left intact. It is risk that affects just Disney. Hang in there with me. You're going to see why this matters. So when you're looking at a Disney movie, whether it succeeds or fails, affects this Disney. What's Disney's big bet now? What's driving their stock price? You've been reading stories about Disney. What's the big part of Disney that's
Disney Plus.
Sorry, Disney Plus and streaming, right? 93
Disney
million
Plus
viewers.
IP, yeah.
It's the fact that they have 95 million viewers, and this is viewed as Disney's future. Okay, I get that. But the world of streaming is shifting, right? In fact, you probably know Netflix is not sitting still. It's still there. And Paramount is, and CBS is renamed it. So what is it called now? I forget now. NBC is the Peacock. Everybody and their brother is now on
Paramount
streaming.
Plus.
Everybody. So when you think about streaming, so the success of Disney streaming is going to depend on how the competitors behave, what their pricing is. So if Netflix drops its price to $8 a month, then Disney will have to react. You see where I'm going? So when you look at Disney streaming, there's risk that affects Disney and a bunch of other streaming companies around it. That risk is risk that affects a few companies, not just Disney, but Netflix and CBS and Viacom and AT&T and the companies in the streaming space. So we've gone from risk that affected only one company to risk that affects maybe 8 or 9 companies. Disney is part of the broadcasting business through ABC, ESPN. Let's say Congress passes a law that affects the broadcasting business, maybe adversely. Maybe it's got something to do with broadcasting businesses and how they get served to people who have, who don't have cable. That will affect Disney, right? It will also affect every other company in that sector. So we've gone from risk that affects one company to a few companies to perhaps an entire sector. Let's keep moving. Let's suppose you look at one of Disney's investments, Disney Shanghai. Okay. That theme park is a big part of Disney's future. Well, that theme park's value is going to be affected not just by exchange rates moving, right? But also by political risk and how the US-China relationship plays out in the future. It's risk that's affected by exchange, but that risk is not just isolated to Disney. Half of US companies have significant Chinese operations, right? So if you think about the Chinese yuan moving or political risk increasing, it's not Disney. You can now be talking about 1,000 companies. We've gone from risk that affects one company to 5 companies to maybe 20 companies to 1,000 companies. I don't know when the next FOMC, the Federal Open Market Committee, is meeting, but this is the Federal Reserve meeting and making judgments about or statements about the future. Let's suppose at the next FOMC meeting, Jerome Powell comes out of the meeting and says, we've looked at the numbers and we see inflation rising. That's all he needs to say. You know what's going to happen in the next few seconds? Bond markets are going to sell off. Interest rates are going to shoot through the roof. And will Disney be affected? Absolutely. But so will every other investment in the universe, not just in the US, but in the universe, because those higher interest rates are going to ripple through. We've gone from risk that affected one company to a few companies to many companies to all companies. Saying, who cares? If you're an investor with all of your money in Disney, which of those risks are you exposed to? All of them, right? Every time something bad happens at Disney, you'll feel it. Or something good happens, you'll feel it. But if you have Disney and let's say 20 other stocks in your portfolio, 20, I mean, let's not get over ambitious, 20 other stocks, they're in different businesses. You know what's going to happen? That first risk, which affects one or a few companies, is called company-specific risk. And remember, it can cut in good ways and bad ways. Some companies do better than expected, some do worse than expected. When you have 25 or 30 companies in your portfolio, that risk is going to average out. It's almost magical until you realize this is just basic statistics. Remember the law of large numbers in statistics? You have 30 companies, good things and bad things happen. And if you have a portfolio, you probably notice this. I notice it when I read the paper. First page, there's a good news story about one of my companies. I'm feeling happy. Page 3, I look at another company that's in my portfolio. Terrible news, CEO's escaped, gone away somewhere. Bad news. So by the end of the paper, I've had 7 companies I've read about, 4 good news stories, 3 bad news stories. That's what diversification is. You don't need a statistical basis. Each investment is now not just a smaller portion of your portfolio, but good and bad things average out. If you get that, you basically have the foundations for modern finance. Because that is really the starting point for modern finance. Because here's the next big assumption that the CAPM makes. It doesn't assume that all of us are supremely diversified. That's completely unrealistic. But it does assume that the marginal investor in your company is diversified. You're saying, what is a marginal investor? Marginal investor is an investor who owns a lot of shares in your company and trades those shares. Both conditions have to be met. So it's an investor who owns a big chunk of the shares and trades those shares. That marginal investor is diversified. Meaning one of the conditions doesn't make your margin. So if you look at Facebook, the largest single investor, of course, is Mark Zuckerberg, but he's not the marginal investor because he doesn't trade his shares, because he's a founder, he needs to hold on to it for control. So you're saying, how the heck am I going to find out who the marginal investor is? Remember that HDS page I showed you for Disney as part of the corporate governance? What did that tell me? The 17 largest investors in Disney, right? And yesterday I took, if you have access to Bloomberg, I took you through looking at, and you can get this as public info. You can go to Yahoo Finance, see who are the investors in my company, what percent of the stock is held by institutions. I'll give you a very simple template for figuring out what type of investor is the marginal investor in your company. If 60, 65, 70% of your stock in your company is held by institutions, you know what I mean by institutions, mutual funds, pension funds, hedge funds. You can dance around this as much as you want, but your marginal investor is an institutional investor. Whether it's BlackRock or Vanguard, might vary across companies, but it's an institutional investor. So high percentage of institutional investors, you're almost definitely an institutional investor. If you have a company where there's a high percentage held by institutions, Facebook, for instance, a high percentage held by institutions, but you also have significant insider holding, it's still the institutional investor who's the marginal investor. But clearly the insider is going to have some degree of play in this. You can't tell me Facebook doesn't care about the fact that Zuckerberg is that, because he is the CEO, he's making decisions, whether he likes it or not, his choices are going to kind of intrude on what the institutional investors want. Of course, you could have a company where very little of the stock is held by institutions. A lot of it is held by insiders. Then you got to ask, who are those insiders? If the insider is somebody like, somebody who's rich enough to own pieces of 30 or 40 companies, guess what? It might be an individual, but that individual is behaving like an institutional investor. Paul Allen, who used to be he was a co-founder of Microsoft. Then he split off from Microsoft. He became part owner of the Portland Trail Blazers, but he owned pieces of like 30 or 40 companies. I mean, he died a couple of years ago, but he was, he actually had a fund that he ran for his personal wealth. If he is your marginal investor, he is diversified. The point here is not whether the marginal investor is institutional or individual, but whether that investor is likely to be diversified. You're saying, what if I have a company where my marginal investor is an individual and they have all their money in my company? So then your company is closer to being a privately owned company than a public company. In India, for instance, if you look at the Indian stock market, there are like 4,000 listings, 3,000 of them no business being even listed. And the reason I say that is these are companies where 97% of the stock is held by the founder and 3% is listed. You say, why do they bother? Just to get a market price. So these are actually private companies where they use the market to get a market price. The marginal investor in that company is an individual who's not diversified. Saying, why does it matter? Because if your investor is a marginal investor is diversified, then the CAPM holds, right? You can, or a model that assumes that only risk that doesn't get diversified. But if your marginal investor is not diversified, none of the stuff we've talked about really holds. So I'll use Disney's HDS page in 2013. I've already showed you the 2003 page where there were only institutions. 2009, the biggest single stockholder was, of course, Steve Jobs. 2013, the biggest single stockholder is Laurene Jobs, because Steve had, when he died, his shares went to his wife. And of course, there's a new name that's popped up on the list. Notice what it is. Who's the person that's on this list who wasn't there in 2009? Oh, George Lucas. What the heck is he doing here? You know how he ended up becoming one of the lead shareholders in Disney?
Disney acquired Lucasfilm.
Disney bought Lucasfilms, and when they bought Lucasfilms, they paid for the shares. There you go. Remember, I felt good about Steve Jobs. I don't know what I feel about George Lucas. He's probably spinning stories about we have to go to another universe. This universe is not working. I'm not sure it's exactly practical advice. But when I look at that list, who's the marginal investor in Disney? Remember the two conditions. You need to own a lot of shares and trade those shares. It's definitely not Laurene Jobs. She owns a lot of shares, but he doesn't trade them. That holding is very similar to what it was 4 years ago. Who's right next on the list? BlackRock. If you have a conspiracy mindset, as you start looking at these pages for companies around the world, I wouldn't blame you if you came to the conclusion that BlackRock owns the world. It's amazing. You can go to any part of the world. I was in, I think I was in Vietnam. I put up the top 10 Vietnamese companies. I type in the HDS page and BlackRock shows up. It's like, where's Waldo? There's BlackRock. There's BlackRock. They do it through their ETFs and their index funds. But is BlackRock diversified? It's kind of an absurdly stupid. Of course they are. They are supremely diversified. So when BlackRock looks at the risk in a company, you know what they see? Only the risk you cannot diversify away. Because the rest gets averaged out. You're saying, but I'm not BlackRock. Guess what? Even though you're not BlackRock, you have to look at risk through their eyes because they're the ones setting the price for the company at the margin. That's what makes them marginal investors. And in fact, when I look at all 5 of my companies, I concluded that at least for my 5 public companies, which are Disney, Vale, Baidu, Deutsche Bank, and Tata Motors, I was on safe ground assuming the marginal investor was diversified. But with Bookscape, the private business, I can't make that assumption. We'll talk about what I have to do differently there. And what this gives me is essentially the license to go to the next step. Because if I'd gotten stuck here, I couldn't have made the assumption that only the risk you cannot diversify away matters. But once I stop there, I can say, you know what? My marginal investor is diversified. I can therefore focus on the risk you cannot diversify away. So on Monday, when we start, we're going to talk about how exactly do we measure that risk you cannot diversify away. And that's where betas are going to come into play. But think of all the baggage we've already accumulated to get to where we are, right? In terms of assumptions we had to make. So on Monday, we'll start on betas. And if you can get the beta for your company, and I don't know how many of you can get into school to get to a Bloomberg terminal, but that link gave, if you cannot get into school, I'll give you an alternative way of getting a beta for your company where you don't have to get to a Bloomberg. But if you can bring that page with you or that number with you to class on Monday, it'll help in the discussion, okay? So thank you very much, and I will see you on Monday.
Thank you.